Greetings and salutations, Real Estate Undergrounders. It is Ed Matthews with the Real Estate Underground. Thank you so much for listening. We're really excited about today's show. Turns out that the gentleman that we're going to be meeting is somebody who knows a whole bunch of people that I used to know. In fact, he lives in and works in my old stomping grounds in Silicon Valley. Frank Rhodes, welcome to the show, CEO of Ownify. And I'm really excited to have this conversation. Welcome.
Thank you, Ed, and excited to be here.
Yeah. And so for those folks that don't know about Ownify, why don't you tell us a little bit about you and your company?
Sure. So my background was really software, as you mentioned, Silicon Valley. I ran a company called Nomis for 15 years, started it, grew it, venture funded business, and eventually sold it. And that company built the software that mortgage lenders use to price mortgages in North America, Australia, New Zealand, UK. And so as part of that journey, building that software, I got really deep into mortgage pricing and mortgage math, which is a fascinating topic for those of you who care. One of the things I learned along the way, and I saw in the data more and more, is that first-time buyers in the US, but really globally, are getting squeezed out of the market, right, for a number of different reasons. And we kept seeing it in the data, and I kept talking to the lenders about it and said, what are you doing? And mortgage lenders, by and large, sell very standardized products. And those are government guaranteed products by and large. So they don't have a whole lot of flexibility around restructuring, rethinking how to help first-time buyers. And as I mentioned, I sold that company. And about 2 years ago, with venture funding from the same VC that had originally funded Nomis, I started Ownify. And Ownify is really focused on helping first-time home buyers in the US overcome the down payment hurdle. And so build an on-ramp for first-time buyers, younger families who are looking to buy their first homes, so starter homes generally.
Yep.
And as part of that, we built an underwriting, valuation, fractionalization platform, as well as an investment fund that allows investors to come in and help solve this problem and at the same time generate returns. And I've had this journey, maybe somewhat similar to yours, Ed, where I started in Silicon Valley, started in software, and eventually but are now in real estate and really real estate financing as the specialty that I focus on.
At first blush, from an investor perspective, this looks like a debt fund play, right? A little bit. And I'm curious, I want to get into the home ownership piece because that part I'm absolutely fascinated by. And it's actually a passion of mine in terms of creating affordable housing, which is a real problem in the country. And but from an investor perspective, can you walk us through how the fund works?
Yeah, sure. At first blush, you might think it's a debt fund or a debt vehicle, but really the way we changed the game here for first-time buyers is to rethink why you need debt in the first place and why traditionally we use debt. And what Ownify has done is effectively said, can we create an equity-based path to ownership for the first-time buyer? And so what Ownify does is it's not a debt fund. It's not a loan or a mortgage. It is actually an investment partnership around single-family homes, where we partner the first-time buyer, we call them the Oni, on this journey to ownership with accredited investors. And so an investor who comes into the fund purchases equity in a home. Now, we do use debt behind the scenes and as leverage for the fund, but the investor really purchases equity and makes an equity investment in single-family homes, or more accurately, in a diversified portfolio of single-family homes. And so the fund, investors in the fund, buy fractional interests in single-family homes, hold them over 5 years, and progressively sell those fractional interests to the Oni. And that is the vehicle by which the customer builds equity in an unlevered fashion. And it's also the vehicle by which the investor generates capital gains through home price appreciation, as well as passive income through rental income effectively. So let me take a step back and explain how Ownify works. Basically, for a first-time buyer, what Ownify provides is the ability to pick a home. And generally, these are starter homes, so think 300,000, 400,000, maybe 500 at the margin. Pick a home. We make an all-cash offer on the home, purchase the home on behalf of the customer, and the customer on day one contributes 2% of the purchase price. So for that $400,000 home, that's $8,000 upfront. That's effectively the down payment. The customer enters into a contract with Ownify that provides for one, a 5-year occupancy agreement. So it's effectively a long-term lease that allows the customer to live in the home. The second component of the agreement is an equity purchase plan where the customer buys equity in the home every month for 5 years. And the way that math is dialed in is that with the 2% as down payment plus the monthly payments, the customer builds 10% of the equity in the home over that 5-year horizon. And then the third component of the agreement is a purchase option that allows the customer to purchase the home from the investor pool at any point during those 5 years at the then current market value. Now, why is that equity rather than debt? The reason it's equity is that each home is held by an LLC, a limited liability company. That LLC issues 10,000 shares. We call them bricks, 10,000 bricks. And every month, as the customer builds their stack of bricks, so they start with 200, and in the first month, they buy another roughly 13 bricks. Those bricks are traded or sold to the customer at the then current market value. Right? So let's say that $400,000 home a month after purchase is now worth $401,000 for argument's sake, right? A brick, which was $40 on day one, is now worth $40.10. So the customer buys bricks at that market value of $40.10. And so over that 5-year horizon, buying equity or buying bricks every month, what the customer is able to do is actually dollar cost average the purchase of equity in the home, right?
Wow.
It's a fixed monthly payment, but they're buying variable number of bricks depending on the value of the home. And each home gets revalued once a month. And so for the customer, that provides a bunch of interesting advantages. One, they can't be underwater because they don't have a mortgage balance. They're building equity alongside the rental payment. And we only charge rent on the portion of the home that they haven't bought. So the bigger the customer's stack of bricks, right, as they increase their equity, the fraction of the home that they have to pay rent on actually goes down. So the rental payment over that 5-year horizon goes down. So that's the structure for the customer. And the big benefit is it's an all cash offer. We take care of property taxes, maintenance, repairs, insurance during those 5 years. So it provides certainty around the payment, right? It provides the ability for a customer to pick a home that's for sale, not just a rental home. And it gives them the on-ramp effectively with these guardrails and a high degree of certainty of being able to buy the home.
And so at the end of 5 years, if I'm doing the math right, the property's probably in an average scenario, figure 4% appreciation, you're looking at 21, 22-ish% increase in value. And wow, that's brilliant. Absolutely brilliant. And so and it totally undermines the whole renting is a better play than homeownership, right? Because Connecticut, for instance, I think the average home right now is about $379,000.
Yeah.
And the average American makes $76,000 a year. In order to afford that $379,000 house, I think the math is they have to make, as a couple or individually, $126,000 a year. And more than half of the population has no shot at home ownership. And this closes that gap.
Yeah. And if you look at our customer base and the folks in the portfolio, they have great credit, right? So our average FICO credit score in the portfolio is 740. So these are folks who have good credit.
Yeah.
They actually have decent incomes right around the area median income, right? In the launch market in Raleigh-Durham, that's somewhere around $90,000, $95,000. And so you look at their income and look at their credit, you say you should be able to afford a house. The big hurdle that most folks have is the down payment, right? And now more recently, also the monthly payment as mortgage rates have reverted back to the long run average, right? And so between house price appreciation, between student debt, which basically everyone in our portfolio has student debt, which drags down their ability to save and afford a monthly payment, house price appreciation, student debt, mortgage rates, and then cash offers in the market, it's very hard for a first-time buyer to compete. And that's really the core solution that we've built, right, is allow those folks who are well qualified to basically jump over the 3, 4, 5 years it would normally take them to save, get into a home now, start building equity, right? And then once they're ready, they can buy it out the traditional way, if you will, with a mortgage.
Sure. So I'm curious, with regard to the 5-year time horizon, is there any flexibility on the back end of that in case, for instance, the economy happens to dip or worse still, tank?
Yeah. So generally we tried to optimize for long enough to give the customer the runway to build up the equity without having the monthly equity purchase be too high. So that's where 5 years is the sweet spot. But we also understand that some customers may need longer, or quite frankly, some customers may not want to buy a home with a mortgage, right? And say, I don't need all this debt. I don't want to own 100% of the home, right? And technically, you don't really own 100% until you've paid off the mortgage anyway. So what ends up happening at the end of 5 years is we just offer a renewal for another 5 years, right? You keep building equity. And so theoretically, you can purchase equity, right, through this process over a long period of time. But you don't get the benefit of leverage as a customer, but you also don't get the downside of leverage, right? And if you think about it, especially for first-time buyers who don't have a lot of assets, not having leverage can provide some real benefits too.
Absolutely. Yeah. If you're in the multifamily world where I live, a lot of the risk in the market these days is insurance is one, but their debt costs and leverage is a huge risk for a lot of folks in this market, because with adjustable mortgage vehicles, it's become a little bit of a guessing game as to when the market's going to come back. The old axiom, date the rate, marry the building, date the rate. And there's a whole bunch of people out there wondering, when do I get to turn this into long-term debt as opposed to the bridge debt, or worse still, recovery debt to navigate the last couple of years, right? And yesterday, obviously, the Fed didn't play along, and they decided to keep the rates right where they're at, and talk about additional inflation risk, which makes guys like me sweat a little bit. But yeah, so I hear you in terms of removing that risk. The other part of it is that, and one of the reasons, at least here in the Northeast, and I suspect this is elsewhere, including your launch area in the Carolinas, is the supply demand curve, right? The fact is that housing, it's very difficult to develop right now. It has been difficult for a few years. You've got the 2008 financial crisis, which wiped out a huge chunk of general contractors and land developers. And they went off and went to law school or B school, or moved into technology or something else, and never came back. And then on top of that, you've got the variable mortgage, or the rise in rates. There's a lot of risk out there.
Yeah. It's interesting. Depending on what statistics and which economists you follow, we're short somewhere between 2.5 to 4 million homes in the US. And depending on which city, which metro area you look at, that is worse in terms of the imbalance between supply and demand. And so that ultimately provides a real need. And we saw this, as I mentioned earlier, I saw it in the data of my prior company. Now we're leaning into this. And what we're seeing on the consumer side is just this huge amount of demand, right? Hundreds of people coming in every day. And because there's lots of demand, from an investor perspective, we can be very selective, right? And today we're accepting less than 1% of applications into the program, which means that we can pick the folks who have the solid income, the good credit, right? The ability to make sure that they ultimately meet their obligations throughout the program. And so what that translates into on the investor side is, across the portfolio, we've not had a single late payment. We've never had a day of vacancy, because we don't buy a home until we have a bona fide customer qualified. So they start paying their rental payment on day one. And because of the ownership mentality, this has been really interesting, actually. It was part of the thesis, and we've seen it now we've been at this for 18 months now with homes actually in the portfolio. What we've seen over those 18 months is that the maintenance cost has been about 60% lower than SFR industry averages, right? Because the folks who live in these homes basically take care of them like they own them, which is the whole intent and the whole idea, right, around this.
Yeah.
And so we're doing little things like, here's a video of how to drain your water heater, right? And show us a video of you draining the water heater, and we'll send you an extra brick or two. And so we can use the equity, this concept of bricks in the home, to really incent that ownership behavior. And what that results in is ultimately higher yield for the investors in the fund, right? Because all of what normally is maintenance expense kind of gets reduced, increases the return back to the investor.
Yeah, absolutely. And so how are you finding your investors? Because this is not necessarily, while I certainly think that there's venture capital money to be within your business model, clearly, but it's also a lot of real estate investor money and family office money. How are you getting the word out?
Yeah. So there are really two types of investors in Ownify, right? There's the Ownify OpCo, the operating company, that is venture funded. And that's where we built the technology, the AI to do underwriting, fractionalization, all that. Then there is the Ownify Home Fund, and that is a traditional real estate fund in the sense that it invests in single family homes, albeit in this new structure that most folks hadn't seen before. And so for the investors in the fund, I think we launched this and built it probably very similar to how most everyone else does it, right? Which is you tap your network of friends and family and all the folks that you know and say, look, here's an interesting opportunity. So we've gotten the first couple of $1 million through that network, right? And those folks have seen nice returns. We then leaned into the local community. So as you mentioned, we launched in the Carolinas, Raleigh, Durham, right, the Research Triangle. And so we have local investors who like the idea of investing in their local community, enabling homeownership, right? Not having New York-based PE fund buying up all the single family homes, turning them into rentals, right? So there's a kind of an impact and a double bottom line component, and a number of investors respond to that. And we just this week started broadening that a little bit more to more of a national footprint to say, if folks are interested outside of Raleigh, Durham, outside the North Carolina footprint, right? Obviously, we'd be happy to provide opportunities. And so right now we've launched a $10 million fund that is going pretty well. We're looking to have 40 to 50 homes in the fund by the end of this year in that launch market. And then from there, I think the playbook is really, let's lift and shift that to the next couple of metros where we're activating local and regional capital market rate investors who like the idea of funding this. And quite frankly, we're offering a 15% target IRR. So far, we're a bit ahead of that. Again, it's early, right? But when you look at the results so far, we're tracking well against that. And so that's attractive because it isn't a below market impact investment that we normally think about solving a societal problem. But one of the things we're excited about is marrying impact with market rate returns and providing that to the investor.
Yeah. And Ed Matthews comes along and he said, okay, you're speaking my language. This is solving a clear problem within the community. A, I'd love you to come into my community, but B, the returns are something that I probably want to learn more about. How are you engaging with investors like me? Is there a webinar? Is there an offering memorandum? Like, how does that work?
Yep. Great question. And thank you for the plug. So the offering memorandum, and we just launched a webinar yesterday, actually. That is now live. You can watch a recording at ownify.com or ownifyfund.com/webinar that walks you through exactly how the fund works, some of the stories, some of the early homes we've bought, the performance so far. And if you're an accredited investor and you're interested in that, you can go through that onboarding, learn everything. There's a bunch of calculators, et cetera. And then also read, obviously, the private placement memorandum. And we use Verivest as a partner to manage the fund itself. So that's where investor onboarding happens. But ownifyfund.com or ownify.com, both of those get you to the webinar. And if you want to reach out to me directly, obviously, that's one of the things. You watch the webinar, you're going to have a bunch of questions. And so the call to action is schedule a meeting, right? Talk to me or any of my partners, my co-founder, Ben, and we'll walk you through and answer any of the questions you might have.
Stay with us. We'll be right back. A motivated seller just filled out your web form. If you call back within 5 minutes, you're nearly 4 times more likely to get that seller appointment. But delay your follow-up by even just 10 minutes? Forget it. You're toast. Ella Vista Connect calls that lead back in 60 seconds, qualifies them, and schedules your meeting. Find out how much slow follow-up is costing you. Free calculator at ellavista.com/underground.
So in the interest of the SEC not coming knocking on our door, I'm going to make one quick point, and that is we are not offering, this is not an offer of securities or a disclosure of any interests. Under no circumstances, any material that we're talking about here should be considered an offer or a solicitation in any way, shape, or form. The only way to get that is to hop on the ownify.com website, go through the webinar, and meet the Ownify team. And we'll leave it at that. So
Perfect. Thank you.
So that's funny. Our securities attorney, Raj Mahali, when I first met him, he goes, what are you looking for in terms of services for us? And I said, number one is keep me on the straight and narrow and don't allow me to do dumb stuff that gets me in trouble. Thoroughly educated. In terms of the operation itself, I'm curious, have you built a lot of proprietary technology to manage your business, or is this more, have you been able to acquire other software enabling technologies to manage your business?
Yeah, it's a little bit of both. So we use a lot of third-party data sources in particular. I think what's unique and where we've spent a lot of time with our tech team and our CTO is building the underwriting and valuation engine. So we use something like 5,000 different data elements to underwrite the individual to make sure that they're qualified from
like 5,000?
Yes. So we actually go and we suck in all of the bank transactions out of someone's checking account. We build a full-blown cash flow based model of their available income and their free cash flow and their ability to support a housing payment. We obviously look at their credit. We look at a bunch of other variables to make sure we fully understand a 360 degree of the customer. And then we look and do the same thing for the home. So the way the process works, and this is unique, is that a customer comes to Ownify.com, they go through the underwriting process. And if they're qualified, we give them a budget. And that says, congratulations, Ed, you're qualified for $400,000. Now we partner you with an agent. If you have your own agent, that's great. But we have partnered agents, realtors. You go out and you shop for homes, and then you submit the home itself to another underwriting step, because obviously we want to make sure that we not just inspect and underwrite the home in terms of an investment asset, but also do so, enter the deal and buy the home at the best price possible for our investors, right? Because ultimately appreciation is a big driver of the returns in the fund. And we want to make sure that we pick homes that will appreciate. And so we've built some really interesting forecast models to look at which homes, not just in a particular zip code, but down to the block level, what is the likelihood that homes are appreciating based on the investment in the neighborhood, based on commercial activity. And so we build a forward-looking 3 to 5 year forecast on what's the appreciation potential.
Wow.
Right?
And please.
Yeah. And so because it's a longer, it's a 5-year hold period, right? And the investment term in the fund is 5 years. We haven't seen the outcome of that yet, given that we started 18 months ago. But so far, we're ahead of the average appreciation in the markets that we're in. And it's based on AVMs. And again, we value each home every month. So we keep tabs on where's the strike price today? Where's the value today? And so between both the customer underwriting and the home underwriting and valuation, it's a lot of third-party data. And then I think what's unique is the ability to then fractionalize those homes. And if you think about what does that mean, we have 10,000 bricks in each home. And bricks are owned either by the investor pool or by the owner. They trade hands every month. At the core of Ownify is a big ledger that we're running that makes sure that we're tracking all of those transactions, the valuations, and then the attribution of rental income, expenses, et cetera, along the way. And that is proprietary. That's not something that's out there because most syndications or funds don't really invest at the brick level, right? You invest at the property level. So breaking that down, it required some work on our side.
Yeah, because the other thing I was getting at is how the heck do you price a single family property, one, in a neighborhood on a monthly basis? From a data perspective, that's a Herculean effort.
So that's actually where third-party providers have helped us a lot, right? And there are third-party providers. And so we've set up API calls into 3 different independent AVM sources. And the interesting thing is the AVMs they're basically backward looking. They look at all the transactions in the market, right? And they look at, this is a 3-2, et cetera. It looks like this. And therefore we think today it's worth X. And whether that valuation is 100% accurate really doesn't matter all that much. We source from 3 different sources. So we work out where the outliers. And because we're only trading roughly 13, 14 bricks in any given month, if that valuation is a little high or a little low, it washes out that 5-year horizon.
That dollar cost averaging you were talking about earlier.
Yeah, exactly right. Exactly right.
Yeah, it's fascinating. Over the course, you're not right today, but over the course of a 5-year period, you're going to be right way more than you're wrong. So that's
exactly right.
Okay. All right. Excellent. We are coming into the latter part of the conversation. So I'm going to switch from getting geeky on you and let's talk about you. So in terms of, I'm always curious about why people get out of bed on Monday morning, right? And so I'm curious if you could finish this sentence for me. My purpose is
to provide a societal benefit, helping people. And so what this boiled down to for me was, I had a software company that was doing well, but the core purpose of that company was to help mortgage lenders make more money. And that's not the core mission in life. So really for me, it's about doing well by doing good, right? And seeing that those stories, right? If you're helping a family, you're helping a single mother of 3, which you just did, right? Buy her first home. That's what gets me up in the morning.
Yeah, I couldn't agree more. Contribution is the highest form of being.
I also have 5-year-old twins, so they're really getting me up in the morning.
There's that, right? But the fact is that your point is well taken. Chase Manhattan is going to be okay.
Exactly.
So Citigroup's going to be just fine. So in terms of your travels through corporate and your personal life, I'm always curious about the mentors and even the coaches that you've had and the advice that they've given that you've put into action and implemented. What's the best advice you ever got and who gave it to you?
This is early on in my career. I worked for a consulting firm, and the partner at the time, who was my boss for a couple of years, a guy named Neil Pomeroy, he had this extremely high degree of urgency. And basically his point along the way was, get started. What are you waiting for? Why are you still talking? Why aren't you doing this? And then more recently, I came across this quote a couple of years ago, which was this, which I really love it, is this quote of, the best time to plant a tree is 20 years ago. The second best time is today. And so the basic notion, the basic piece of advice is just don't wait, get started. It's great to dream. It's great to plan. But at the end of the day, what matters is getting started. And so Neil gave me that piece of advice, and that always stuck with me. And
Great point.
I think it's part of the drive that gets me up in the morning as well.
That's great. So in terms of sharpening the saw and continuous learning, I've yet to meet an executive or someone who runs a company that doesn't take in information on a regular basis. Leaders almost always tend to be readers in some way, shape, or form. So I'm curious about how you sharpen that saw and take in information, physical books, audio books, something else. And then I'm also curious about who you're paying attention to these days. Who's on your nightstand? Virtual.
Yeah, I read physical books. I read on the Kindle. I had a rule that I started with when I was 16, to read a book a week, and I haven't broken it so far. Every now and then I have to cheat and I find a really thin book.
Yeah.
And
Blinkist counts.
Exactly. Something short, Dr. Jekyll and Mr. Hyde or something like that. And yeah, so reading is obviously probably the number one way in which I take in information. I listen to podcasts, right? Running, working out, whatever, on planes, commuting. Who am I paying attention to? I'm enjoying, I don't think he's very well known, but there's a guy named Kevin Erdman out there. He's a housing economist, and he's got what I would say orthogonal thinking to the mainstream. And I've really enjoyed his books. He has a newsletter out there, so I follow that. I really like the All In podcast. I think a lot of folks are listening to that, right? Always fun, the banter and some of the insights that's coming out of that. And I'm reading a really interesting biography about Jimmy Carter right now, who is, as we're recording this, hanging on and maybe fading away. But I think there's a great book called His Very Best, which I highly recommend.
If you could, as we're wrapping this up, also tell me what success means to you.
I think it goes back to this doing well while doing good, right? Having this double impact where you're doing well for yourself and for your family and your investors. So there's a monetary component and a success component, right? But there's also are you creating a net positive in the world? That's really my definition of success, is looking at both of those.
All right. When not forging ahead with and making home ownership available to a whole swath of people that might not get that shot, what do you like to do for fun? How do you spend your time?
So I have the 5-year-old twins, right? They keep me busy.
That's enough.
I enjoy biking, mountain biking, road biking. I have an e-bike that I put them on. So we do a lot of adventures around the city and into the headlands out here in Marin. And and just trying to stay in shape and juggling a lot of balls with a new company, relatively young kids, right? And reading. I think the other book I'm reading right now, there's a great new translation of The Odyssey out, which is such a phenomenal, you can take 3 pages and just read 3 pages, and that's your zen for the day. So I do that for fun too.
All right. Yeah, it's funny you mentioned your twins again. I had a conversation with my uncle, and chose not to have kids way back in the day. And when my kids were a little older than yours, they're now teenagers and one's in 21. But he asked me, what do you do for fun? Like hobbies? What do you do? And I'm like, those 2 little girls over there running around. That's
it. Yeah.
Everything I do. Yeah. That's 90% of Saturdays and Sundays and after work. Hey, Frank, I've really enjoyed this conversation. I've learned a lot, and I appreciate your insights on the market. And also congratulations on your successful launch of this company. It's really exciting. And I am very much looking forward to watching this company grow. If people want to learn more about you or about Ownify or anything else that we talked about today, what's the best way to get in touch with you?
Email is always the easiest and fastest. Frank@ownify.com, Ownify. Yeah. And I'm happy to hear from any of you and engage on whether that's investment or partnership or coming to your market, right? You mentioned definitely looking for the right partners as we roll this out.
Absolutely. Frank Rhodes, thank you so much for joining us today. I'm looking forward to seeing Ownify take off. And as soon as I'm done hitting record, or when I hit the record button and turn it off, I'm gonna pitch you on why you need to come to Connecticut, because it's a great market.
Fantastic. Thank you, Ed.
This has been the Real Estate Underground. Don't forget to subscribe. It helps us grow. Until next time, Undergrounders, remember your real estate journey begins with a simple step forward. Now get to it. Bye for now.